All right, we're going to get started here on our chapter 12, Risk and Rates of Return, the sequel. Um, we've left off, as you recall, with market risk. And one of the things we want to understand is how do you understand how volatile a stock is or a portfolio of stocks? And they have a term for that. It's called its beta. And the beta is a measure of how the stock or the portfolio of stocks moves versus the S&P 500 price index. And we can do a beta for either a single stock or a portfolio of stocks. And betas typically range from zero point 0.5 to 1.5. If a beta is zero, it means there is no variation with the market. And if your beta for your stock or your portfolio is 1, then it means it varies perfectly, exactly the same as the market. And we'll be talking about that in class and maybe try and think of some examples of high beta stocks and low beta stocks when we get together in class. Figuring out the beta, well, you plot the results of the stock or the portfolio against the S&P 500, and then you draw a best fit line. It's actually a regression line, but it's called a characteristic line. And the beta is the slope of that line. And remember that slope is rise over run. One way to remember that is you must rise from bed before you run into class. And some notes here, we're actually using regression analysis to draw the characteristic line. We won't be doing that in class, but that's how they get it. The beta varies due to the time period being analyzed and who's doing the measuring and how often they're taking their plot points. And it is not always a good measure of a company's risk, so you need to be sure to use your judgment. And we'll talk a little bit about that in class, hopefully. A portfolio's beta is simply the weighted average of the betas of each stock held in the portfolio. You've seen this table before when we did the weighted expected rate of return, etc. Again, we're going to take the stock and the percent of the portfolio that we have in that stock times the beta for that stock gives us the weighted beta for each stock. We sum those up and that gives us the beta for the portfolio. So calculating a portfolio beta, Disney, if the portfolio was made up 40% of Disney stock and the beta for Disney stock was 1.15, then we would multiply zero point 0.4 times 1.15 to get our weighted beta for Disney. We would do the same thing for Coke and for Nike. We would sum those up and that would be our beta for the portfolio, and we'll be doing plenty of that in class. And here's another example where you would be able to see that we've changed the portfolio percentages in each of the stocks. The question is, what does that do to our beta? Now, on to investors' required rate of return. There are two pieces of an investor's required rate of return. The first is the risk free rate, and that's the amount of money they get just for waiting for their money. The second piece is the risk premium, and that's the amount of money that they get related to the risk associated with your stock. And the book, I think, refers to that as the worrying portion of the return. As you can see, we have two different representations of the formula, and you'll be able to choose whichever one you like best. But it is essentially the required rate of return is your risk free rate plus your risk premium. In the case of CAPM, which is the capital asset pricing model, you use the required rate of return formula to determine the return needed on any specific stock. What you need to know are three things: the expected rate of return for the market, the risk-free rate, and your beta. And here is your formula, and it's the required rate of return equals the risk-free rate plus the beta for your stock times the market rate minus the risk-free rate. And we'll be calculating that in class. Lots of fun. Project risk. Important things to remember is that the opportunity cost of capital depends on the use of the funds, not the source. So whether you get it from issuing stock, or whether you get it from issuing debt is irrelevant. Your opportunity cost of capital and the risk associated with it is always measured by the risk of the project itself, and that's the use of the funds, not the source. Your opportunity cost of capital increases with higher fixed costs. That makes sense, because you have more of a hurdle to get over, and also higher betas because there's an opportunity for you to go up or down even more. Uh, One of the cautions in the book is not to fudge the opportunity cost of capital. And many companies use a slightly higher cost of capital to take into account the fact that they might not have gotten their free cash flows right. And our advice to you is get your free cash flows right in the first place, and that should get you in great shape. And that is it for our very short Chapter 12 video, and we're looking forward to seeing you in class. We're going to have some fun